And good afternoon, everyone. This is John Hutchinson with Traders Reserve. I want to welcome you and thank you for taking time out of your day to join us today. We have a great presentation for you planned, and we're going to get right into it here in just a couple of minutes. I want to make sure that everyone has a chance to get in, get their audio set. As always, I remind folks who have been on our webinars in the past that the audio does experience a brief delay from the time that I speak to the time that you hear. So please understand that that's normal. If you do have any problems where the screen freezes, depending on whether you're watching on your mobile phone or on an iPad or other tablet-like device, or if you're connected to a Wi-Fi versus sort of a hard internet connection, you may experience a screen freeze. If that happens, just log out and log right back in, and that usually fixes the problem. So we will be getting underway here in a couple of minutes. This presentation is being recorded, so if you miss anything or if you have to leave early, don't worry, you'll be able to catch up with the replay. We'll have the replay automatically go out to you by email in just a few hours. Before we get started, one thing I do want to do is to make sure that everybody can hear me okay and see my screen. You should see the title slide of our presentation today. If you would, just take a moment to type a yes or a Y in the chat box to the right of your screen, and feel free to let me know where you are from as well. We always like to know how far around this wonderful Earth our presentation is reaching. So I'll give everyone a minute or two to do that, and while you're letting me know that you can hear me okay, I will do a few housekeeping details. You're going to walk away from this presentation today with 3 trades that you yourself can make. We've modified our earnings player presentation a bit, in part because we have found 3 very powerful trends that we believe you as traders will have an opportunity to essentially profit from this earnings season. And we know the market's in a corrective phase, but that should not dissuade you from taking advantage of earnings season, and we'll show you exactly step by step how you can do that in this presentation. I do have a special guest, as always, with me, and I will introduce him in just a few slides, and I want to say thank you. Oh, Dave from Central Coast, Mort from New York City, Linda, Florida, Austin, Texas. I was just in Austin a month ago, and actually just in Santa Barbara last week, so some great places around here. Indio, California, Indiana. Great. St. Louis, Missouri. Congratulations to your Cardinals there, James, and good luck in the NLCS. Silicon Valley, keep making those chips and programs there. Seattle, Washington, big Seahawks fan here. So great. Thanks, everyone, for letting me know that you can hear me okay. Let's get underway. I do have to do the typical U.S. government required disclaimer, so please be patient while I read this. U.S. government required disclaimer: Forex, futures, stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the earnings player methodology or system or the information in this presentation will generate profits or ensure freedom from losses. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades may or may not have been executed, the results may under or overcompensate for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Isn't that lovely? It's such a killjoy to have to start with that, but we have to do it. So it makes the lawyers happy, and as we do know, there is risk in trading any markets, so we want to make sure that you're aware of that. Anyway, if you happen to enjoy watching paint dry, water boil, or grass grow, you're welcome to read both our privacy policy and our disclaimer on tradersreserve.com. With that, however, let's move into the meat, so that I know many of you are probably on your lunch hour, or if you're in California, your breakfast hour. So I want to get through this in about 30 to 40 minutes. We will take questions at the end. We'll stick around to answer as many questions as you folks have. We will also have a very special, this is the first time I'm ever doing it with a webinar, a very special offer for the earnings player at the end of this presentation. So for those of you who don't like the sales pitch, I just want to let you know that it's coming so that your time is not wasted, but you will still walk away with 3 trades that you can make, and we will go through those trades one by one in this presentation. So take notes, ask questions, and we will take care of all of them at the end of the presentation. But if you happen to be an investor who needs fast growth of a small account, wants immediate gains of 100 to 500% or more, and enjoys using options for what we like to call big gain hunting, then I want you to get ready to sweep up some profits this quarter during earnings season. And what we're going to share with you today is a simple strategy that you can use to double your money or more with the trading process we're going to teach you. Now, this is a way that you can exploit the earnings game on Wall Street for significant profits. And by exploit that game, what I mean is, if you think about earnings in the context of how companies sort of guide earnings now, there's a big game taking place where companies are guiding Wall Street lower so that they can knowingly beat that number and get Wall Street to bid up the share prices of their companies. But sometimes surprises happen and companies miss earnings, and there are significant moves that take place in companies if you know how to take advantage of them and if you know how to find those trades. We're going to teach you both of those things here in this presentation. And what you'll learn is there's a simple way to use options trades to double or triple your money during earnings season, and we're going to teach you the 5 quick keys to finding those fast-moving trades and profit potential. And you can do this in 30 minutes or less per week. It is that simple. Once you find a trade, you're in and you're out, and it's not day trading. This is one thing I do want to make very clear. Our process actually covers 2 different trading days, or encompasses 2 different trading days. So you're in and out. It doesn't take very long to do, so you don't have to be glued to your screen. You don't have to be watching prices like a hawk. You can place your wager, so to speak, and then collect your gains the next day. That's how simple we've made this. And here are some examples of trades that we've made over the last several months. A put option that we had on Intel when they missed earnings jumped over 150%. A company called Weatherford International beat their earnings estimate, and a call option gained 200%, and that was just in a few hours. Good old luxury retailer Coach, they missed their estimates by the fabled country mile, and that put option was worth over 327% in gains after execution. And finally, one of our biggest wins in the past 2 quarters, America Online. We had a put option on that one, and they missed their estimates badly, as we expected, and the put option on that one jumped 525%. Now, this is the potential. I will tell you that there are losing trades. As I said at the beginning, there's no system created that wins every time. But what you're going to learn from this presentation and from the expert I'm going to introduce to you in just a moment is the ability to win more than you lose when you have a losing trade, because your winners are winning at 2, 3, 4, 500%. And we'll show you more of those example trades as we get to the latter part of this presentation. But right now I want to bring on and introduce my earnings expert, Jamie DeLugas. If you don't know Jamie, or even if you do, just a reminder, he's a 25-year veteran and investment professional. Hobart Financial Digest previously ranked his Rational Investor a #1 newsletter. He currently writes for investment websites which include Traders Reserve, MSN Money, MarketWatch, TheStreet.com, and others. And he is an investment analyst and the expert behind both the Earnings Player and working with me on the Millionaire Blueprint. So Jamie, I want to welcome you and thank you for taking time out of your day to work with us today. And to get us started, I know you're a big fan of earnings season and earnings in general. So what is it that you like so much about earnings?
Hey John, thanks for having me today. I'm super duper excited to be here. You got it right. Earnings season is here, and for me, it's Christmas time. Why do I like earnings so much? Well, as you can see in the stock market, there's a lot of speculation day to day that's based on things like fear, for example, Ebola, things like terrorism in the Middle East. All sorts of speculative fears in the market can impact prices. And what I like about earnings is that for a very brief moment in time, you get a very real indication of true value. Because ultimately, when you're buying stocks, you're buying equity in a company. And buying equity in a company means you get to participate in the future cash flows of that company. And the value of a stock can be referred to as a discounted present value of those future cash flows. And so guess what earnings does? It tells you, in essence, again, for a very short moment in time, what those cash flows are going to look like. And so oftentimes the speculation is wrong. So what happens when earnings come out, you get wild fluctuations in stock price to adjust to that valuation reality, if you will, that blows away the fearful speculation. And so because of that, to me, trading earnings is probably the most reliable thing you can count on in the stock market today. So John, I'm really excited about it.
Great, Jamie. Thanks. Let's get down to talking about the 5 keys, and we'll move to that slide here in just a second. But the process that you've been using over the last several months has largely been, or has specifically been, centered around call and put options. How have those options, or how has options changed the earnings game for you?
Right, and like I said, the beautiful thing about earnings is it creates almost guaranteed volatility, because the market 9 out of 10 times gets the pricing wrong on a stock, and so earnings is that shock to the system, if you will. And so the question for me, arose several years ago: how can we capitalize on that known volatility? And the best way to do that, and with a very low capital commitment up front, is put and call options. Because of the unique leverage potential of options, you can place a trade before earnings are released and then close that trade the very next day for oftentimes triple-digit gains, 100, 200, 300%, and sometimes even more, as we've experienced in the last 2 quarters.
Well, then let's start talking about how you find the right trade. You have a series essentially of 5 keys, which we call the quick keys. Just give us an overview of those, and we can revisit some of them as we walk through the 3 specific trades that we're going to be previewing here today.
Right. So many of you are probably asking yourselves, well, yeah, it's easy to trade earnings, make a trade before earnings, and then close the trade after earnings, but how do you know how the company is going to report? And the answer to that question is, if you really analyze it, the market is giving you clues every day. And so I developed these 5 quick keys that you can look at yourself to identify how a company is going to report earnings and what the market reaction to that report is going to be. So real quick, I'll go over the 5 quick keys. Number 1 is looking at the current sector trend. Are there any unusual or overlooked trends in the markets? Right now, the airline sector is getting beaten to death because, as I mentioned before, of the Ebola scare. While it is a very real and potentially problematic issue, I don't want to diminish the fears, and tragically the patient in Dallas, it was just announced, has passed away. So it's a horrible, horrible thing. But again, how it's impacting the stock is fearful. So I look for those opportunities where the market really gets it wrong. And then I go back to number 2, valuation, valuation, valuation. Because ultimately it is about valuation, and that when there's speculation, the market frequently over or undervalues companies, and that these trends appear just prior to earnings reports. Then I look at earnings expectations. So before earnings, you have Wall Street estimates, and has the company recently missed or beaten previous expectations? I look at past performance. How has the company done against the number? Sometimes they beat the number, sometimes they miss the number, and oftentimes there are trends that you can identify within past performance. And then as far as the future is concerned, that's where I look at current estimates. Are they rising or falling? The numbers change over the last 90 days, and you can see how Wall Street, again, is reacting to current information in the market to get a good idea of how a company is going to report. And putting all of this information together, combined with current market sentiment, number 5, oftentimes the market just has corporate earnings wrong. I don't know why that is, but I can guarantee you it'll happen time and time again, which is why this program is so unique in that you can do it. It's repeatable over and over every quarter. Like I said, it's like Christmas time every 3 months of the year. For a 6-week period that we trade earnings, you can capitalize on these market mispricings.
And in looking at the current landscape of earnings, just so everyone has a good centerpiece from a calendar perspective, today is the day that Alcoa reports. They report after the bell, and that is typically the start of the S&P 500 earnings season. Now, the vast majority of S&P companies will report over the next 6 weeks. So the trading opportunity, while it is ongoing because companies report earnings throughout the year, we have found the best 6 weeks to essentially find these types of trades that you have where you have this opportunity. Now, so far with those companies that have reported, it's about a 50-50 split. Some interesting numbers that I was researching today found that half the companies who have reported earnings for the third quarter so far have missed their expectations, and half have beaten their expectations. So we don't have a specific trend developing in that regard just yet, but we will over the next couple of weeks as the big boys, so to speak, begin reporting earnings. So let's move on to those three trends and those three trades, Jamie. I know you mentioned airline stocks, and they were one of the key trends that you were talking about. But overall, just give us the flavor for how these trends have started to sort of inform your thinking for the earnings season upcoming.
You know, if you're a stock investor, uncertainty and volatility is going to, potentially drive you crazy. But for trading earnings, I absolutely love it. And what you're seeing in the market right now is a earnings player dream, where yesterday, for example, the Container Store reported same-store sales. The stock drops 20%. SodaStream warns in the middle of the quarter that their sales are going to fall short of expectations. The stock drops 22%. If you can have the ability to identify some of these possibilities in advance, now we don't have an exact crystal ball, but by using those 5 keys that I mentioned to you, we have a high degree of certainty that we can get the earnings trade correct. And when you get it correct on a stock that's going to move 20%, that's how you produce 300 and 500% winners. And given what's going on in the market today, I know for a fact that there are going to be many triple-digit gainers this coming earnings season. So go ahead.
Let's start with the airline industry.
So for several quarters, as you know, we've ridden, well, some of you may know, we've been trading the airline industry. If you've been with us before, we've made money trading options on the airlines and also with the Millionaire Blueprint by trading the stock. The sector is remarkably powerful right now, and many stocks in the group are trading 10 to 20% lower than their 52-week highs. And there's really no basis for why they're trading lower other than some fear, irrational fear about Ebola and maybe global slowdown of economies in Europe and what have you. But the reality is the industry parameters are still very, very strong. I'm expecting earnings-related surprises to the upside. The valuations are very low on a specific stock-by-stock basis relative to expected profit growth. Because there's industry consolidation, that's an old theme now, but it's a theme that we can trade and trade and trade over and over again. Because once a monopoly or oligopoly is entrenched with tight capacity, that gives you a huge amount of pricing power. And if you've flown recently, you know planes are full, and there just isn't enough capacity to negatively impact profit margins. So I'm expecting higher than expected profit margins as well in the airlines.
And just to add on to that, if you as an investor or as a trader start looking at the airline industry, the airline sector, not only is the industry consolidation especially in terms of the two most recent mergers, United and Continental and American and US Air, not only are those reducing the supply routes, but that consolidation is giving the airlines, you'll notice, an absence of fare wars. If you think back to the 1980s and the 1990s, fare wars were essentially the talk of the day, almost on a regular recurring basis. You have no such problem with the airlines today. In fact, the one thing that airlines have done in the last 5 years is they have figured out how to be profitable. You have, across the industry, you have labor peace, no non-existent fare wars, so higher prices, fewer seats, more air seat miles flown, full flights. When you put all of that together, this is one of those sectors where over the next several years will continue to be or should continue to be one of the most money-making sectors in the American economy. And a good example, we're going to talk about American Airlines here in a few minutes, but a good example is Delta Airlines. A number of years ago, 3 years ago I think it was, they were trading around $7 a share. And their current, that at the time, their price to earnings ratio was ridiculously low, about 5 compared to the S&P average. Well, ultimately Delta grew so rapidly, their stock price has grown 5 times over, up into the 30s, and they were added to the S&P 500 index earlier this year. So the potential for extreme growth in the airline sectors is a trend that you as a trader and investor should keep your eye on. And that means watching all of the major airlines, keep them on a watch list, watch their earnings reports. United Continental has not been one of the stronger performers. They've actually been one of the weak sisters. But many of the other airlines are extremely profitable. We all know and probably hate paying those bag fees, but I'll tell you what, the airlines are making money off of those fees. So trend number 2, Jamie, retailers.
Right. The chaos in the retail sector is another example of where the market gets it wrong, and I suppose for good reason. You know, the sales numbers for retail stores, depending on what type of retail, have been inconsistent. So there's a lot of uncertainty in the sector, and that uncertainty again is something that I believe you can predictably trade when earnings come around.
And just a quick break for Drew and Hal. Drew, we will get to your question a little bit later in this presentation. So that question is actually already answered in this presentation. Thanks for asking. And Hal, if you'll remind me at the end of the presentation, I will go back and we'll go back through the 5 keys, but we'll also be talking about them as we talk about the individual stocks. So Jamie, the big trading apparel surprise was Nike.
Right. So, you know, here's an example again when I say the market gets it wrong, and then when earnings come out, you see a big move in the stock. Look no further than a week or 2 ago, Nike reported earnings result that blew away expectations. You know, and interestingly, a lot of their strength came in, guess where? Europe. Well, wait a minute. Everybody that's screaming on the television is telling me Europe is slowing down. Europe is slowing down. God forbid, you know, the earnings are going to be horrible. Well, the reality was they weren't. Nike is a dominant player with expanding profit margins, especially in their shoes. The stock jumped 10% the day after their earnings were released. That tells you that the speculation had it wrong.
And the last of our sectors to watch, and we'll talk a little bit more about the retail sector because it is a fickle sector, so to speak. But the last one is the third leg down that's taken place in the housing market.
Yeah, you know, I think this is a pretty easy trade to make. There are some significant headwinds for the housing market. The last 2 years have been very good for the sector. Inventories have come down, new construction has gone up, and it's been a bull market. But now you've got interest rates potentially going higher, and you also just have some saturation. You know, the investor world, hedge funds, were dominant players in the first couple of years of the housing recovery. In 2011, 2012, 2013, those buyers were supporting markets and helping stabilize prices, and in fact seeing prices go up because of the demand for housing stock. Now, looking forward, we're not seeing strong numbers that could sustain the valuations that have happened in the home builder sector. Third quarter economic data was mixed. We're seeing some good news, some bad news. And it's just not good enough to support higher prices in the sector. And so recently KB Home announced earnings that disappointed the market, and the stock dropped, I believe it was 7 or 8%. So again, if you identify these trends in advance, they are tradable. Again, it's not a perfect system, but if the odds are in your favor to make an earnings-related option trade with a put or call option, where you can make more than triple digits on your money, you don't have to win a lot of trades to add some extra cash to your portfolio, which makes this program really unique.
All right, let's look at the three stocks that we want to use to exploit these trends. And we've already given away the first one, American Airlines. What are the basis? What's the basis for this trade?
Yeah, I haven't looked at the percentage drop in the last day or two, and it's gotten hit hard with the selling this week. But American Airlines shares are significantly lower, 10 to 20% lower than their 52-week high achieved this summer. There's a disbelief in profit growth in analyst estimates, or simply profit taking. One never knows why a stock is mispriced. I just know that when you see earnings come out, there's often a dislocation that gets corrected after earnings. Now, here's something that I'm really excited about for the airline sector. When American Airlines reports the impact of jet fuel prices falling and falling dramatically isn't getting talked about nearly enough, and therefore I don't believe the impact of lower fuel prices is priced into these stocks. So there's, again, a preponderance of evidence that tells me these stocks are going to jump after earnings. The numbers should be very strong, and because of the selling in the stock, you could see an easy 5 to 10% move, which is going to give you 1 to 200% gains on call options with American Airlines.
And that crude oil, jet fuel, if you will, that issue, or that part of this issue, is actually going to be present for several months, in part because, if you folks out there don't know, what most of the airlines do is they essentially hedge their fuel costs by buying essentially futures in oil. And as the price of oil has come down, that means that they will start to experience, not only during this current quarter, but also probably for the next quarter and the quarter after, essentially money that flows to the bottom line. So not only are they going to be making more money because they're spending less now for jet fuel, but as they continue to do so, that money that flows literally to the bottom line for these airlines. So it's a profit windfall for many of them. And one of the best, historically, one of the best companies at hedging fuel prices has always been Southwest Airlines. They were traders before they were an airline, and those guys, they were brilliant at predicting the future of oil prices. But let's talk about some of the quick keys here as we look at valuation, Jamie, and sort of the expectations in the across the sector, the trend as we're talking about. And if you could just give us a couple highlights about what jumps out at you. This, by the way, folks, is from Yahoo Finance. You can get to this information on the Analyst Estimates tab once you type in your stock symbol of any stock you're looking at. And this is down at the bottom of the Analyst Estimates page. But Jamie, I mean, I've highlighted some of the things that we've talked about here, but what's jumping out at you so much?
Well, it's really apparent how cheap this stock is when you look at the price-to-earnings ratio compared to the market, compared to the industry. At 6.3, American Airlines shares are incredibly cheap. And one reason they might be cheap is an expectations that earnings are going to be lower in the future. And that's just not substantiated with the reality of the industry. We know that profit margins are actually growing. We know that jet fuel prices are falling. So the mispricing here is really remarkable. And one of the reasons I like to trade off of valuation is because I know that investors in general, when they buy stocks in the market, and I'm talking about the institutional managers, the ones that can move a market, the first thing that they are looking for in a stock, generally speaking, is growth, profit growth at a discounted price. Ding, 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 ding. Look at American Airlines, 6.3% and something like 30% or near 30% profit growth year over year. I mean, it's such a no-brainer trade. Not only am I, excited about it for the earnings season, but for those of you that are in the Millionaire Blueprint, we own it in our Millionaire Blueprint portfolio. So the stock. So it's that really jumps out at me, John, is the valuation discrepancy here.
And let's bear in mind that American Airlines actually came back from the dead. This is a company that had declared bankruptcy, came out of bankruptcy, went public again, very similar to the General Motors of 2010, as they went through the same significant reorganization. But what should jump out here as well is when you compare American Airlines against their sector, their growth estimates for profits are 3 times higher than the sector overall, and twice as high as the S&P 500. So if you're looking for, this is an example where not only are you finding the potential for a sort of a short-term earnings trade, you're also looking at a stock that you could use over a short-term period of investing, medium, even long-term. Now, this is a company that has good growth prospects, as do a couple of the other airlines that we like and are using in our Millionaire Blueprint program. But from an earnings perspective, you have a ridiculously cheap company, and one of the things that we've been watching, and we've seen this happen throughout the year, is we talked in the quick keys about future expectations, and you can see on this chart, again from the analyst estimates page, the number of upward revisions to the earnings growth estimates for American Airlines, not only for the current year, which ends in December, but also for next year, December of 2015. So when I say this is a stock that's very good for the earnings for the season ahead, but it also has implications in your portfolio for a longer term basis as a buy and hold prospect. And that's the reason why. When we traded this earlier this year, we saw their numbers being upwardly revised by over 50%. In terms of growth estimates. So this is a good example of the kind of quick research, quick analysis you can do. The numbers tell the story for you. You don't have to run calculations. You don't need a supercomputer. You can let your eyes show you what you need to know, or sort of tell you what you see. So here are the expectations that we have, and Jamie, I'll bring you back in as we go through these, but we expect American Airlines to beat earnings. As Jamie pointed out, the stock is priced cheap relative to its real growth. The price for fairer valuation should be closer to $45 a share. That's around the 52-week high. It's typically been trading in the low 30s, the low to mid 30s. But as we pointed out, global growth concerns, certainly the fear of around Ebola, it's an unknown impact as to how it will affect airlines, because obviously the only way it's getting into the country is on flights from West Africa. So don't fly from West Africa. It would seem to be the simple solution. Nevertheless, Jamie, you want to get in before the company reports earnings. And when do you know offhand when they report?
I don't. I'm thinking it's the third or fourth week of October. I can
That's right.
Real quick.
So what we want to do, and we'll walk through this again at the end, is we would want to have a trade in place just prior to the company reporting its earnings. The reason for that is...
I'm sorry, it's October 23rd.
Okay, so we would want to get in prior to October 23rd, and we'll give you an actual trading plan when we get down through the other two, as soon as we get through the other two companies that we're walking you through today. But you would get in just prior to the earnings report, and the reason for that is because you want the fullest possible impact of that earnings report. If you trade too early, you're actually trading the market. You're not trading the event. That's an important distinction. So Drew had asked a question via the private chat here of, do you buy 2 weeks out, 3 weeks out? No, you're actually going to buy as close to that earnings date as possible. And again, we'll give you the actual strategy here in a little bit. But the reason you don't want to buy 2 or 3 weeks out is because then your option play is essentially prone to the actual market forces that are taking place. And it's not based on the specific event of earnings occurring. So again, we'll come back to that in just a few minutes. But let's get on to our next. This is our retail apparel play, Under Armour. And Jamie, you're bearish on Under Armour.
I am, and this is one of those retail stocks, apparel company stocks, consumer stocks that is what I would call priced to perfection. And in a market like this, which we're seeing any sort of disappointment be absolutely punished by investors the very next day, to the extent Under Armour doesn't deliver an absolutely perfect report, you're going to see this stock drop 10 to 15%. So I am bearish on Under Armour. It has a huge, huge, huge premium valuation. Again, trading at 74 times 2014 estimated earnings. Although profit growth is expected to be strong, if they fall short of those expectations, and again, we're trading probabilities here. It's not that I can guarantee you that they're going to miss expectations, but I've identified an opportunity for you to trade with a put option that, to the extent there's any negativity in the stock, in this kind of a market sentiment environment, you're going to have a very significant move and a triple-digit trading gain in a put option for Under Armour.
And I think a couple of the points that you really were focused on was the fact that the company is they're always on the edge in terms of beating expectations. And when we look at this company, as you can see in the second red bar there, the number of rising or upwardly revised earnings expectations is significant for the company. So there's a lot of pressure on Under Armour to deliver the number this quarter.
Yeah, that's right. And a 1 or 2%, manage the number, manage the expectations. Most likely, it's not going to be about that. It's going to be how are revenues coming in, and if revenues fall even slightly short of expectations, or if the company reduces guidance looking forward into the future, that's where you're going to see a huge drop in share price.
And one last point on Under Armour for folks who want to do a little bit of their own research and take a look at that analyst estimate page on Yahoo Finance. One of the things to look at is for the company's 2014 earnings, more than 50% of their earnings are expected to occur in the next 2 quarters, and yet they've barely made their earnings in the last 2 quarters. So it's again, as Jamie said, it's a probability that this company will probably barely meet expectations, and at that juncture, the market is likely to essentially react negatively. But you actually think they're going to miss their earnings, if I remember correctly, right?
I do. I think let's put it this way: there's a stronger likelihood that they're going to miss either on the top or the bottom line, or they're going to reduce guidance. Those are the 3 things you're looking for in an earnings report. So revenues, profits, and then guidance. And if any one of those 3 things show a crack, this valuation just isn't sustainable.
All right, let's move on to our third one, D.R. Horton.
So D.R. Horton, and here I'm just basically trading a trend where I think the headwinds in the housing market combined with not so great I guess lukewarm economic activity in the U.S. combined with just where we're at in the cycle being a little bit tired. You've got summer housing data that wasn't encouraging. Consumers are still skittish. Incomes are not rising fast enough to get people to buy homes. We all know the millennials are living at home for a longer period of time. So things aren't horrible in the home building sector, but they're not good enough to sustain what is now what I would call higher valuations.
And the only part of that market that's largely been expanding has been the luxury home market, which is also representative now of one of the smallest parts of the buying public. So you were connecting DR back to KB Homes here. What did you see in KB Homes that kind of got you on the scent of DR Horton?
Well, again, most of these home builders now are homogenous. They all participate in the same markets for the most part, and you don't have regional diversity in the home building sector like you used to. And so what happens for one home builder is more likely to happen for another home builder. As far as valuation is concerned, DR Horton trades for 1.5 times book value. Historically, the time to own home building stocks is when they trade for below book value. And so though 1.5 times is by no means super expensive, it is on the high side. And so to the extent there is any slowdown in housing, which I think is very likely given the way that the statistics came in over the summer, you can have a significant earnings miss going forward for the third quarter.
And they missed badly back in the previous quarter, missing their earnings by 34%, and that was no small miss.
That's right. And so at the same time, expectations have barely changed. So you have a forward look at the market back in the June quarter that says, hey, things might not be as rosy as you might think. You have the macro data telling you that things aren't as rosy as you might think, and yet complacency in Wall Street estimates tells you, ho hum, things are status quo and we're not changing our expectations here. Well, again, that's where the market gets it wrong. And when earnings come out, it shocks the stock back to reality. And if there's another 35% earnings miss like they had last quarter, this stock is going to drop 5 to 10%.
Or more. This is, if you look, folks, on a daily chart on DR Horton, you'll see frequently this is a stock that can move anywhere from 10 to 20% in a very short period of time. So if you make an option play on this and the company misses earnings, as we expect it to do, you could stand to make a substantial gain on that particular trade. So let's talk about the actual trading plan for those three stocks. Again, they are American Airlines, AAL is the stock symbol. American Airlines reports on October 23rd, and you would want to buy a call option, and we'll come back to this in just a second. For Under Armour, Jamie, can you give me the dates on give everyone the dates on UA and DHI as far as their earnings reporting dates, just so we have them out there? But for Under Armour, you want put options because, again, we expect that company to miss its earnings, and in which case you can look forward to a fairly significant repricing of the stock. And DR Horton also put options, as again we believe that company is going to miss its earnings. Now, the plan that you would execute is to buy the options just prior to the earnings release. That means within 1 or 2 days. Now, we'll give you our actual strategy with the earnings player in just a few slides, but I just want to give you a general plan here so you have a way to play these three names. So you want to do that just prior, so within 1 to 2 days of the earnings announcement. Now, if I remember correctly, American Airlines reports, excuse me, before the bell. So you want to make sure that you're in no later than the end of the day on October 22nd, because you want to be in before that earnings announcement comes out. So if a company reports after the bell, again, you want to be in before the market close on that same day. But our preferred approach is to use at or just in the money options, and our top secret tactic here is to use weekly options. And the reason for that, the reason we use weekly options, is because two factors work significantly in your favor when you use weekly options. The first is time decay, which means that there's a limited period of time for the option to essentially survive, to live. But that time decay also affects the volatility or the price of the option. So if you have a company that's reporting on a Tuesday or a Wednesday and you're making a very short-term trade here or covering a couple of days, the price momentum will move so rapidly that, as we'll show you in a few slides, that's how you get those triple-digit gains of 100, 200, 300, 400, 500%, because the market has to significantly reprice that option to match the stock price of the company. So we've found that using weekly options and buying at or just in the money presents the best opportunity for return. Now, again, we're not going to get every trade that we make in our earnings player program right. We don't expect that, but the potential for large gains is that's where we're placing our bets, if you will. So let's move on to exactly what the earnings player is, and this is going to be a special invitation for everyone to join us. As I said earlier, I'm making a special offer today for earnings player, which I have never done before. It's a web-only special, if you will, so just bear with us as we talk you through this program, and then we'll come back around and do Q&A so that everybody can have all of their questions answered, especially relating to the three trades that we've given you on American Airlines, UA, and DR Horton. And again, you'll see our actual strategy for earnings player as I go through these next few slides. But the earnings player is it's a 6-week program. It mirrors the top 6 weeks of earnings season. So when 85% of the S&P 500 are reporting, that's when we want to be in the game, so to speak. So it begins on Monday, October 13th. That's next Monday, and it will run through Friday, November 21st. So that's the best 6 weeks where you have the majority of the companies with weekly options who have the potential for significant price movement, both up and down. Now, we make weekly options trade recommendations every week during those 6 weeks. That you will get 3 to 5 trade recommendations each of those 6 weeks. So anywhere from 18 to 30 total trades over the 6 weeks. We deliver those to you via email in a special report on Mondays at noon Eastern. It includes your trading plan for the entire week, so you know exactly which options trades you're going to make and which days you're going to place those trades. And I'll give you the step-by-step here in the next couple of slides. Now, the trade recommendations, as we've talked about before, are simple options trades. You're buying a put or buying a call with a specific entry and exit price instruction. Now we give you the strike price, we give you the option price that it's trading at, so you know exactly how to execute the trade for the maximum impact. And again, it's not day trade because you're trading over or across a couple of trading days. You're not classified as day trading, and it takes a total of about 30 minutes to do. So it's very simple. We've made it that simple, and the reason that we stick with just a straight option is we found that with spreads or straddles or other weird option plays, I guess is the simplest way to state that, with other option strategies, those strategies, while they do limit your risk, they also significantly hamper your profit potential. So it's one thing to keep in mind. For those folks who trade other strategies, you can employ those strategies with the earnings player if you know how to do them. If you know how to place a spread or a straddle, you can certainly work with the information. You have enough information given to you to work with them. But the reason that we stick with a simple buy on a put or a call is because it gives us the greatest return potential. For when we have those earnings calls right, and when the market moves in the right direction, that's where we're getting those 2, 3, 4, and 500% gains. Now, the way that we, again, are doing this, the way that our program works, is we buy a call or a put at or just in the money. Now, we take a look at those prices at the beginning of the week so that you know and tell you exactly where to place those trades. And we're always using the current week's weekly option. So for all of our trades next week, they'll be based on next Friday's expiration date. So that's the 18th, right? Yeah, 17th. So they'll all be the weekly option that expires October 17th. Actually, I think it has an 18th. It's a Saturday expiration date, but that's the weekly option. So it's a very simple play. You're simply placing a weekly option for that week's expiration. You get it in at the last hour of trading prior to the earnings report. So for the 3 trades that we've given you, you can now take our strategy and use it yourself. Again, we want to be in typically the last hour before the company reports earnings. So typically around 3 p.m. Eastern time or New York time for those of you not in the United States. And that gives us the opportunity to capture the move at the open the next day, because one of 2 things happens when the company reports earnings. They either report after the bell or before the market opens the next day. So you need to have that trade in place to capture the maximum move when Wall Street gets shocked, so to speak. Now, so again, whether they report after the close or before the open, you're placing your trade on the day prior to or the day of that report. Now, for example, Alcoa reports today after the market close. So if we were to have a trade on for Alcoa, and let's say that we were going to sell a put on Alcoa, we would want to buy our put between 3 and 4 p.m. this afternoon. That way we have our trade in place. Alcoa then reports after the close, and then we'll get our results the next morning, and we'll be able to close our trade out typically after the first hour of trading. Sometimes if we have a big winner, sometimes we'll let that trade run until the close, until about 3 p.m. that same day. We've done that a few times, and that has given us sometimes additional 50 or 100% gains on top of a significant move. If it's a losing trade, we generally recommend closing it out right away. If for whatever reason the market moves in the wrong direction, or if the company surprises us, then we want to get out of that trade as quickly as possible. You simply close it either at the open or within the first hour. You're going to have a few losing trades that you can't, obviously you can't make an omelet without breaking eggs, but it's Jamie, as you like to say, it's the winners winning more. And so we're going to talk a little bit more as we get down to the capital management and profit plan, but anything you want to add to the strategy execution that you put in place each week?
Sure, and I think just as important as identifying the right trade, I think it's critical for anybody that's following this program to follow our strategy basically down to the T. And by that I mean you're going to have a certain number of trades during the quarter. Now some of these trades, this is a very potentially high risk proposition. If you're wrong about how the company is going to report and where the company is going to, or how the market's going to react to that report, you potentially can lose 100% of your investment. But that's okay. The reason that's okay is because I know I'm going to make 300 or 400 or 500% on another trade down the road. And so if you have a capital management strategy, keep your capital investment the same throughout the entire 6-week program, the proposition that we have for our subscribers is that by the end of this, our winners are going to win more than our losers lose. Typically, we're going to hit on anywhere between 50 and 65% of these trades. And so therefore, if you just follow the program, let's say $500 per trade, you potentially could add $2,000 or $3,000 to your portfolio, and the risk, well, I think the risk is minimal. You're not risking a lot of your capital. So because you're placing only $500 per trade, and at most we're going to have five trades during the week, so that's $2,500. So it's critical. You know, some last quarter, for example, you know, the first couple of weeks didn't go so well. You know, the 5 keys pointed us in the wrong direction, and that's okay. That happens. I've been doing this over a number of quarters, and I know that eventually we're going to get it right, and we did. It's hard losing money in the beginning, so if you're new to this program, I just say, you know, be patient, because the winners will come, and the goal is, like I said, to put extra cash in your pocket if you become one of our subscribers.
And oftentimes what we find is the first couple of weeks, the market is digesting overall earnings. And so sometimes what we see is that the market doesn't move as strongly in the direction that we expect it to. But as earnings start to build up steam through the quarter, you tend to see weeks 2, 3, 4, and 5 as the big profit centers, because now the market is moving. They're either moving more rapidly out of a stock that misses or heavily into a stock that beats. So just a quick example of what you can expect with our weekly trade recommendations. Again, you're going to get up to 5 recommendations each week for the 6 weeks of earnings season. You'll get a capsule, if you will, an analysis on the company's performance. So you'll understand the basis behind the trade. And the reason for that is so that you're not just trading for trading's sake. You want to know that you're making an intelligent trade. So Jamie does all of the analysis using the 5 keys that we've just walked you through, and for Hal's purposes, we'll go back to those in a little bit here. But he'll walk you through, you know, what is the expectation for the company? How has the company been performing? Why do we see this company beating or missing its earnings for the current quarter? And then what you'll get is the specific weekly options trade to make, including the entry day and the entry strike price. Now, we base the strike price that we want to enter at based on where the stock is trading at the time that we put out the trade recommendations. Sometimes we have to adjust that price, which we will do, and on the next slide I'll show you with our daily updates. But generally speaking, we want to be at or just in the money. So if a stock is trading around $35, you're typically going to see a $35 put or call as your trade recommendation. Now, this good example here of AOL, this is one of our biggest winners of the year so far, 525%. I'll recap that for you a little bit later, but you can see the analysis was there. The rationale for making the trade and the actual trade to make was placed for you, so you knew exactly what to do. And then once you place the trade, one of the most important things for you to know is that you're not alone. Trading's a lonely business. It can be, you know, when you don't have other people working with you, so to speak. So what we do is during the course of the week, you know, first you get your what we call the earnings player hot list on Monday, which gives you all 5 trades for the week and when to execute them. Then on Tuesday, Wednesday, and Thursday, and sometimes on Friday if we have a Thursday trade operating, we give you a daily email update which covers all of the open trades and gives you specific exit instructions, which as we already pointed out, you want to close losing trades right away within the first hour of the market, but you want to try to let winning trades run up until as late as 3 p.m. of that day. But we will give you those exit instructions in the daily email update after the market opens. So once we've seen the earnings report, once we've seen the market response, we can then better inform you what to do with an existing trade. And we do that with the daily email update every Tuesday, Wednesday, and Thursday, and sometimes on Friday. And then also on Fridays, we do a weekly wrap-up as well as a preview session for the next week, so you have an idea of what happened the week before and what to expect in the week ahead. So just to give you some flavor for how you can profit from these, here I've got 2 slides to share with you. These are our money doublers, are basically 100 to 200% gains. This is a short list. I didn't put all of them on here, but over the last couple of quarters, you can see we've had 100, 105, 156, 172, 176%, and you can see retailers, you can see chip makers, online portals, gaming companies. So there's a very broad mix of companies that we use this strategy with. As well, on top of those trades, we've also had these big trades: Whole Foods for 200%, InvenSense for 201%. I still can't pronounce that company's name. Baidu for 268%. In fact, just in the last month, in August and early September, we had Canadian Solar for 400%, and the retailer Cons for 400%. And again, AOL, which was a May trade, that was over 525% gain. So the big numbers are there, and as Jamie talked about, the ability to win more than a loser loses. Remember, your losses are going to be capped at 100%. That's the maximum loss that you can incur. But your profit potential is not capped. It's only capped by the market. So what you're going to experience are big winners, some losers, and at the end of the day, when you add it all up over the 6 weeks, you'll make more than you lose. That's how we approach it. That's the purpose. And so let me give you Jamie and I will work on this slide together here. It's what we call our profit plan, or your capital management strategy. And as we said at the outset, you can expect a maximum of 30 trades to make over the 6 weeks. But I want to point something out that's very, very important on this slide. Remember that your capital is tied up only for 24 hours. Now, with the exception of a losing trade that loses 100% of its value, that means your winning trades, all of that capital will be available for you the next week. And the objective for you is to simply start small. We do not recommend betting big on any trade. Don't bet more than you can risk losing. So don't use anything more than 1 or 2 contracts maximum. You don't have to. In the box that you see here in blue and white, and I'm sorry for the colors on that one, then this is a 1 week's example of 5 trades that we placed in the earnings program a little earlier in the previous quarter, and you can see there are 5 names there. You can see the buy prices meant that you would have, for one contract, laid out $1,600, and when you sold those contracts at the sell prices, you would have returned a little over $1,900. So you had that significant move in your money in just a couple of days during the course of 1 week, and now you have that capital to use for the next week. So you can actually start small, build capital up, and continue to use the same money week after week after week. But Jamie, I want you to talk about the last point, the most important one about staying in the game.
You know, that's easier said than done, and I totally understand that. But again, if you buy into the idea that you can make money trading earnings, and I unequivocally believe that you can, then you've got to play the game the entire 6 weeks. And in some cases, you might have to go quarter over quarter over quarter to realize the real potential. So if you start, and I don't want to overemphasize this because we've had quarters where our first 2 weeks are spectacular. So it just so happens that last quarter, and we had a fairly significant marketing push, and so we had a lot of new members that were excited to be trading earnings, and I get that. And you always want that first trade to be the one that works. But I think if you, again, by following a program, so if you're going to play the game and you say, I've got $5,000 that I want to allocate to this, and out of that $5,000, then I would make my trade size anywhere from $250 to $500 on each of these trades, and that's it. So any week you could have a completely whitewash where you lose 3 out of 5 trades or 4 out of 5 trades, and you lose 100% on these trades. And you go, wow, well, if you do $250 or $500 a trade and you lose 4 out of 5, that's a net 3. So now you're down $1,500 of your capital. But by week 2, week 3, week 4, you get that money back. And if you make money in the first few trades, then you're playing with house money, and you don't have to risk your own money at that point. So it's really a neat thing. And I can, for those of you out there, I have a mother who's 74 years old, and like a lot of you, has just an average size portfolio, and she plays the earnings game. She played it last quarter, and the first couple weeks I wasn't invited to Sunday dinner because she lost money, but she believed in it. And now I gave her extra hand holding, and I said, you got to keep playing, you got to keep playing. And she did, and she ended up profiting close to $1,500 in her account. She bought herself an extra plane ticket to go see her daughter in California, and all is well. And she couldn't be happier that she played this game. So it's really important that you stay in the game. And that's a long-winded way of answering that question, John.
So by the end of the summer, you were eating again, is what you're saying?
I was well fed, yes.
Well, let me share, folks, with you a couple of success stories from members who have worked the earnings player game with Jamie over the last few quarters. Michael told us banked $2,700 in back-to-back weeks. That was back in the second quarter of this year, and he will, I'm sure, be back again this quarter. Jay Nelson, impressed with the strategy. Just as we've shown you, triple-digit gains, double-digit winners. He had an overall gain of 40% to his trading account in just over 2 months. That's what's possible here. Actually, I repeated that. I apologize, but you can see that's how quickly you can ramp up money. You don't have to bet it all. You don't have to bet the farm. You can take small gambles, if you will. As we showed you, some of those trades on the last chart there would have cost you $78 to $100 essentially for 100 to 200% gains. So it doesn't take a ton of capital, and you don't need to do that. If you want to be able to use earnings on an ongoing basis throughout the whole calendar year, this is the best strategy to do it. Now, what's included in the private trading program, and then we'll stop and do Q&A here in a second. Again, you get the top 5 weekly trade section selections during the 6 weeks of earnings season. You get daily email updates on open trades, plus our weekly wrap-up and sneak preview for the next week. And as I said, I'm doing a special offer. I've not done this in the past, but the regular price is $349 for the 6 weeks, but for today only, and because you folks are attending our webinar, we're going to give you advance reservations, if you will, for $149. That's less than $5 per trade for the 30 trades that we expect to make during the earnings season. And Jamie sometimes even comes up with bonus trades, so that cost per trade would go down even more. So for less than $5 a trade and an opportunity to double, triple, or quadruple your money in the coming earnings quarter, this is my best offer to make to you to get you to try this so that you can have a great experience, have an opportunity to put cash in your account, and learn how to put those 5 keys to work for yourself to find your own earnings trades. Because not only do we do the work for you, but we also teach you how to do it as we go through the quarter. So I'm going to give everyone the pop-in box here over on the right so that you can start reserving your spot right now. Just click the Get Started button that you see under pop-ins, and that will take you to the reservation page. Again, this is not a recurring billing. I want to make this absolutely clear. You are simply buying this quarter. We don't make it one of those recharge your cards every quarter kind of programs. So reserve your spot right now for the opportunities. There are going to be some very big trades. We've already given you 3, and we'll go back and give you some of the dates that folks need on UA and DR Horton in just a minute here. But again, $149 for the 30 trades for the 6 weeks of earnings player. Again, less than $5 a trade for the opportunity for 200, 300, 400% gains as we've achieved over the last 6 months and beyond. We've been doing this for a couple of years now, but the last 6 months have been really stellar because of the volatility in the overall markets. So let me start working on the chat box questions here. So, Dave, I'm going to give you everyone that link right now in the chat box. You can click that. That'll take you right out to the sales page, the order form, so that you can reserve your spot. Thanks for letting me know that you had to leave. James asks, because you announced your trades on Monday, could other traders take advantage of this information? James, the only way they could really take advantage of that information is if they were getting the same hot list, if you will, that you were getting. Now,
Can I jump in on that? Because I think that's a really good question.
Absolutely, go right ahead.
A lot of subscribers may wonder about. And this is actually another feature. John and I talked about this in a different sort of way this morning. But it's another reason why I absolutely love earnings trading is because the potential for market maker manipulation is slim and none. In other words, when you look at an option at a given moment in time, and especially with respect to weekly options, you're dealing with intrinsic value, okay, which is how much in the money an option, and I'm getting into the weeds a little bit on how options price. My point is there's intrinsic value and then there's time premium. And with a weekly option, there's less time premium. And that's where the potential for manipulation is. And because there's a very low potential for manipulation, if other traders somehow capitalize or find out our moves and try to make a move on an option before we do, it's not going to take away the opportunity in the least bit. And I think that's a really cool thing.
All right. So a couple other questions here. Hal asked, and Hal, I answered you privately as well, but Hal asked, are there Monday trade entries? Yes, from time to time, but the vast majority of the earnings reports are the earnings trades are made between Tuesday, Wednesday, and Thursday. You'll occasionally have a Monday entry, but when we're getting out the report at lunchtime, we hope that gives everyone more than enough time. If we have a Monday trade, we'll try to give everyone that advanced heads up, just so that we can make sure that everybody gets that trade placed in enough time. Drew asked, what about losses? I think we pretty much covered that pretty in depth. Earnings heating up, less capital for these. So Hal also asks, I would ask that last comment about earnings heating up after a couple of weeks. Should I allocate less capital for these initial trades? You can take that approach. Again, take the one contract approach in the first week, first 1 or 2 weeks, and as you're getting the results and as the market starts to move, then if you have additional capital, you can add in weeks 3, 4, 5, and 6. But a great question. Thanks for asking that, Hal. Helen asks, why not buy both calls and puts? Helen, that's actually a spread or a straddle, which you could use that kind of strategy with. But the main reason that we don't buy both is one is guaranteed to be a losing trade, and it doesn't guarantee that you're going to offset one versus the other. Doesn't mean you can't try to do it yourself. If you're buying a call or a put at the money, one of them is going to go up and one of them is going to go down in most cases, unless it's Gilead Sciences, which has been a thorn in our side all season. So, Jamie, what are the UA and DHI reporting dates? I want to update these real quick here.
October 23rd and November 11th.
Which one? UA is 10/23?
UA is the 23rd, and DR Horton is November 11th.
All right, so let me just update that as the sticky. So again, American Airlines and Under Armour both report on the 23rd. So in that instance, your trade placement would be on October 22nd. And at the latest by 3 p.m. So then for DHI, your trade placement would be November 10th by 3 p.m. So that's how you would play those three based on our strategy or using our strategy. Again, you'd be buying a call on American Airlines and you'd be buying puts on UA and on DR Horton. So that sort of cleans that up for everybody. Let me back up here for I know. Can you show Jamie's 5 quick keys again? I can. Give me just a second and I'll roll back to that page. All right, Jamie, if you just a quick recap on the 5 quick keys for finding the right trade.
Sure. So you're looking at sector trends. Are there any unusual or overlooked trends in the markets? And we talked about the airline sector being one that the market is anticipating really bad news. And for what reason, I'm not sure. I guess mostly on this Ebola thing. The second key is valuation. That ultimately, when earnings are reported, it's at one moment in time where valuation really does matter, and speculation does not. So, and that's actually why we trade the night before, and then we're out of the trade theoretically the next day. Oftentimes, some folks ask the question, why don't you let your winning trades go beyond that one day? And that's a good question, but typically, after an earnings pop, the very next day you get right back to speculation. So a good macro example of that is the recent jobs report last Friday was really strong, and the market rallied significantly because it was an absolutely perfect number, and it lasted all of what? One day, so before fear and irrational trading returned. So we close these earnings trades the next day. Number 3, earnings expectations. How has the company performed against the number in the past few quarters? Past performance can be indicative of the future. Then we look at analyst estimates in the future. Are they rising? Are they falling? And then we wrap it all up with market sentiment. And is the market overly bullish at a time when the 5 keys tell us a stock is going to underperform? That could create a really huge earnings opportunity if that is the case.
Scrolled right through past to the end. So we'll put that slide back up here in a second here. Sorry about that. So let's see. We have Drew asks, we get entry and exit alerts. How are the alerts sent? For this quarter, Drew, they'll all be sent by email. We've simplified the alerts so that you know exactly how to take the action that needs to be taken. So the email alerts always come out with the action to take right at the top of the email, so it's very quick and easy. You don't have to sort of worry about drilling down into some long email to get the information that you need. We put it right at the top so you know exactly what to do when it's necessary to do so. And then T asked, by waiting to the last hour, does implied volatility increase the price, which can cut into profits? It can, but it isn't necessarily something that we are following in that, because we're not focused on that factor of the option. What we want is to have that trade executed at the last possible moment, just before the earnings surprise, if you will. So if you think if you're thinking in terms of implied volatility, in part what you have to think is that the market already expects a different event to occur than the one that they previously expected. That's probably a convoluted or circular logic explanation, but the market's not going to move until it has the known event take place. So we've not seen significant movements in the price of the options. Has it happened? Yes, but generally speaking, it happens after the earnings announcement, not necessarily before. So let's see. Dave, thank you. Glad to have you. Looking forward to working with you. Michael, are earnings player veterans getting this or a better offer? Our earnings player veterans are getting the same offer, Michael. So we'll be happy to have you get in for the quarter. Then how long have you been running this program? What's your success rate over time? We've been running this earnings player program a little over 2 years. As Jamie said, every quarter is anywhere between 50 and 60 to 65% winning trades. But even when you're at the lower end of that scale, you're still looking to get those 100, 200, 300% winners that more than offset sort of a 50% win rate. And one of the other factors to keep in mind, and I referenced Gilead Sciences just a little bit ago, the thorn in our side, it's a good example to give you. And that's a stock that if you don't know Gilead Sciences, just a real quick synopsis. They produce a drug called Sovaldi. It is designed for hepatitis patients, hepatitis C patients, and it cures hepatitis C. That's an important distinction. It's not that it doesn't prevent. It doesn't slow the disease down, or it cures it. And the reason that's important is because more hepatitis C patients, if you will, wind up developing liver cancer and other forms of cancer born out of hepatitis C. So by curing hepatitis C, if you so to speak, Sovaldi prevents these more expensive treatments, but the price of the drug is outrageous. It's $80,000 for the treatments. So when Gilead first started reporting earnings, they were blowing the doors off of their earnings expectations. I mean, Jamie, yourself, you said you'd never seen anything like this in years of trading earnings, and we were on the right side of both trades. We were long on Gilead, reporting earnings and beating earnings estimates, and in each of the last 2 quarters, they did exactly that. And the stock price didn't move. In fact, it actually went down a little bit on one of the day in the second and third quarter. So sometimes the market won't do what you expect or want it to do. So that can affect the overall results in terms of sometimes you're going to get out with a 5% gain or a 25% gain or a 10% loss or a break-even trade. So we typically are counting the big winners for our. As you're looking at the results that we shared with you earlier, those are the ones that really drive the growth or the profits and the profit potential in this program. But we're not going to win every trade, and we're not going to tell you that you're going to win every trade. And you don't have to. As you'll discover, if you win 2 or 3 of the trades each week, you're doing very, very, very well. So, but thanks for the question on that one. I do appreciate that. Let's, Hal, I will look into that and let you know. Kerry, when you say keep your trade size the same, do you mean same number of contracts or same dollar value per trade? Kerry, you would start with same dollar value per trade first, because if you have an option that's 50 cents and another option that's $1, then you've got 100 times each of those prices to buy one contract, so $50 and $100. So if you're allocating, say, $500 maximum, then you could theoretically buy more contracts of the 50-cent option and fewer contracts of the dollar option, even though your trading value or trading amount remains the same. Let me know if you understood that. That's just essentially the capital management perspective. So you start with the dollar value and then determine the maximum number of contracts that you can buy. But again, especially during the first week or two, keep your exposure limited. Buy 1 or 2 contracts. Don't get greedy. Learn to work with us. If you haven't traded with us before, again, we're not going to win every trade. We don't have to. But as we start getting through and we start finding those 300%, 400%, 500% winners, you'll be glad that you do it this way. Even if you come out with smaller gains in the first quarter, you'll know when you come back in the January quarter to do it again, you're going to know exactly how to execute the trades, and you'll know exactly how much more risk you'll be able to be willing to take with these types of trades. But a great question, Kerry. And again, let me know if I explained that in a clear enough way for you to understand and for everyone else to understand. Poor Hal has lost his internet connection. Hang in there, Hal, and I will get to you on all of that. Looking forward to celebrating on Thanksgiving. Yes, we are too, Michael. Next up is, actually, I think I've caught up most of the questions here. All right, so we'll do a last call for questions. Again, we're limiting this to 150 traders. In part, that's just to ensure that the number of contracts, available contracts, if you will, is high enough so that everyone can participate in the trades. The deadline to get in is going to be Sunday, October 12th. That's this Sunday at 11:59 p.m. After that, we will close the program and work with the traders on record of that day. And again, $149 for the 6-week program. That includes up to 30 trades. Again, you get the hot list on Monday by noon. You get the daily email updates Tuesday, Wednesday, and Thursday, and the Friday recap. From time to time, we may even find a bonus trade, which we will make sure that everybody gets their hands on, because sometimes, as was the case with Cons, that was a big winner, but it actually occurred outside of the primary 6 weeks. So more for everyone else. Hal, okay, so your question about when to get out of the trade, if it's a losing trade, Hal, you're going to exit within the first hour of trading the next day between 9:30 and 10:30 a.m. If it's a winning trade, you generally want to let that trade run as late as 3 p.m. of that trading day. Those are the exit instructions. So again, a losing trade, get out quickly between 9:30 and 10:30. A winning trade, let it run as late as 3 p.m. However, remember that with our email updates, Jamie will always give you instructions about closing those trades. Typically, if he wants you to close it earlier, he'll give you a time frame. He'll say close it before noon or by noon. But if he wants you to let that trade run through the rest of the day, he'll tell you to close it by 3 p.m. if it's a winning trade. So that's Hal, that's the answer to your questions about precisely when to exit or get out of a trade. Can you post a link again? Absolutely, Michael. Give me 1 second, and I will get that up there for you. Or not. Give me a moment here, and I have to go find the notepad. I had it on for myself, and I'll put that back up in the chat box here in just a second. Again, for everybody, and also in the admin notice. So again, you've got everyone should have their 3 trades in American Airlines, Under Armour, and there's the sticky with the checkout box as well, and DR Horton. So again, try those trades. We'll be following them too. We'll probably be making them as part of the Earnings Player program. But again, if you're looking for a way to ramp up a small account, if you like to go big gain hunting, if you just like having winners in hand, this is a program that can deliver all of that for you. And we look forward to everybody being with us. We will again send out a replay of this in just a few hours by email. So if you missed any part of the presentation, don't worry, and you'll get that replay. We'll also email that to everyone again tomorrow. The special offer is going to be live for about 24 hours, so the people who have a chance to watch the replay can still get in. And again, we have a limitation of about 150, actually limitation of about 112 traders. So welcome to the 38 people who just joined us today. We're looking forward to working with all of you. Hal, stick around, and I'll just make sure that you are taken care of. And Jamie, any last thoughts?
Yeah, I do actually have a last thought. This is a really fun program. When you execute a winning earnings trade, it's a rush. To watch and a lot of times when you get an earnings pop, it just runs higher throughout the day. So and as a stock runs higher above your strike price, you know that your option is just rip roaring, and so you can be going from up 100%, up 200%, all of a sudden you're up 300%, and by the time the market closes, you've got that 400% winner, and you're going, wow, this is, I mean, when there's so much nonsense in the stock market, this is just a great fun program to be in. So I look forward to working with all of you guys. I'm really excited about it coming up, and thanks for coming.
All right, that's it. Just a quick note to, let's see, Hal, I got to check on you real quick and make sure that you are okay. Give me just 1 moment, and I will do that. And for everybody else, let's see. Hal, I'll just answer you privately here, but the answer to your question is no, it didn't work. So let me send that back to you and make sure that you know. Let's see, a couple chats. I want to make sure that that's covered. Good. All right, Jamie, you are excused. I know you have a lot of work to do to get ready for trades next week. So I will stick around to clean up the last minute details here. Take care of Hal and anybody else who's here. And but for Jamie DeLugas and the Earnings Player, I'm John Hutchinson with Traders Reserve. I want to welcome everyone to the Earnings Player who have joined today, or who has joined, and we look forward to working with all of you. So that's it for our presentation. Again, you've got your 3 trades, and we'll keep following those for everybody, but we look forward to having you all on hand. All right, so again, get in before Sunday, and your first hot list will be in your hands on Monday by noon, and we'll be off and running for the earnings season. Let's have a good one, Jamie.